So what is a range? So a range is an area of consolidation prior to a break in market structure for either a continuation or a reversal. So essentially what we're looking at here is an example where I have this higher time frame market structure drawing in green, where it's an uptrend, right? Very clear as day uptrend, nothing fancy, where we can pretend this is 4-hour market structure. We have a 4-hour higher high. We have a 4-hour higher low. And near the higher high and near that higher low, you can see that there was an area of consolidation. This is what we refer to as a range. Okay, these are areas where many retail traders would think it's an area of indecision, whereas the more smart money approach is to call it an area where liquidity is being engineered for a continuation or localized reversal, depending on how you look at it. The reason why I say depending on how you look at it is because by now we know that there are different versions of market structure. So from this high, if we were to continue on with the structured drawing, you would have a downwards trend, because obviously how else can price get from this high down to that higher low in the first place? There had to be some sort of downwards trend. Now, in saying that, the range is formed near the bottom of that downwards trend. Okay, so what this downwards trend is telling me, and this area of consolidation is telling me, is that smart money had retail traders think this was an area of indecision where they're trading side to side to side, essentially, or trying to, whereas ultimately we were trapping traders into thinking that the market was going lower when it didn't really make a whole lot of sense from the overall higher time frame market structure pull. Right? So these areas of consolidation, you can think of ranges as an area where smart money engineers stop losses, just like in that liquidity video where I mentioned, the sell stops and the buy stops on either side of a range. You'll get the same thing, same idea. So ultimately, they can appear trendless. So many folks may be too zoomed in. Perhaps they are so zoomed in, this is what they see. Of course, they wouldn't see all the labels, but they are so zoomed in on that little area down there, and we'll pretend that this is actually here. This little range down here is up here now. Right, so retail traders, the average trader may be zoomed in, which is fine. There's nothing wrong with being zoomed in here. But without really understanding the structure that's behind this range on a higher time frame, then it can be quite misleading to trade past, say, the range high or range low, because ultimately you may get a little bit too biased in the wrong direction without fully understanding how a range works. So within a range, there are 3 main points. The 3 points are always going to be the swing low forming, your swing high forming, and the range equilibrium, which is a 50% retracement using a Fibonacci tool between the swing low and the swing high. Now, in the future videos in the range series, I'll be going over a lot of this stuff as well, but what we do know is that you need these 3 points in order to make a range. So how do you confirm a range? Well, you wait for a swing low to form, or you wait for a swing high to form, then the opposite to form, and then you wait for the midpoint to touch. Very key, you do not have to have a reaction off the equilibrium, or rather the midpoint of that Fibonacci retracement level, the 50% retracement. You do not need a reaction. So if I see a candle like this, that's still a valid range for me. And that's how I draw a range. I also draw a range in the same direction that market structure is facing. So if I'm seeing that price is clearly in some sort of downwards trend, then I'm not going to pull my high before my low to draw a range. Not what I use as a tradable range anyhow. We're going to use the low to that high and then the midpoint being touched. Then we would take our Fibonacci tool and say, oh, look at that. We have a range possibly. Now, remember, there's many instances where even I draw a range and it ends up breaking down right away. Okay, that's fine. That's perfectly fine. We just keep drawing them because ultimately you will find that one area of consolidation. So what I call a tradable range is a range where it's consolidating for an extended period of time that presents multiple trade opportunities. Whereas you may see like a 1-minute range that it's just 1 minute structure that you're drawing. You're like, oh, you know what? We just had the rules for a range, but we broke down from it already. Again, it doesn't necessarily mean that every single hump in market structure, this being what we call a hump, okay, that's a hump, that's a hump. These are not necessarily all tradable ranges, but they are what? They are supply ranges in a downwards trend. in an uptrending environment, each one of these areas, if you had taken your Fibonacci tool, dragging from the high down to the low, which is how you would follow the structure, seeing that price, oh wow, look at that. It actually hit the midpoint upon forming a swing high, a swing low. If I touch my midpoint, I have a range. Well, yeah, technically it is a range. It's just not what we call a tradable range. It's a demand range. So we're not trading the inner contents of this because it broke up immediately. It didn't really have a deviation. It didn't have a sweep. So that's the difference between supply and demand ranges and a tradable range, I'll call it. This is an example of a tradable range. So we had a swing low that formed, we had a swing high that formed, and we had the equilibrium being touched right after forming that swing high. Notice what happens at the low here. So we had a swing low that was swept. And this goes back again to that liquidity video where I showed you guys that there are buy and sell stops on either side of a range, right? And this is where retail traders get stopped out quite often, leading to trapped traders in a move to the other side of a range. And that's how ranges work. It's the same idea. And that would be in my liquidity series, right? So what we're looking at here is, okay, look at that. So we had people shorting the lows. We had sell stop orders that were triggered upon the break of this low because folks think that we're going lower and continuing on with this downwards trend. But that was not the case here. This is an area where smart money decided to hold price up and to trap traders into thinking that this is it, right? And this is where they would have been able to get into their long positions here, here, and here. The areas of extreme discount. And this is where we would actually talk about what is discount? What is premium pricing? I hear that terminology, but I don't know what it is. It's very simple. So premium pricing is an area in the upper section of a range, whereas discount pricing is an area in the lower section of a range. And when I say section, I'm referring to the upper 50% being premium and the lower 50% being discount pricing. So quite clearly, knowing that, would you really want to be focusing on shorts in discount pricing? I would say not. Ideally, that's not the case. You would look for longs in discount pricing of a range. In premium pricing, you would not look for longs, you would look for shorts. That's what we want. We want shorts down here. We want longs down here. In any range, really, in any range. Now, obviously, there's more criteria to that, like e.g., if this was, say, somewhere's like down here, if we go back to that original drawing right here, if we realize that price just came into a hefty area of resistance, maybe we just had a liquidity purge from a previous market structure point, or this is a big old supply zone right here, or supply range, then you wouldn't really expect longs to be a great idea, would you? Because obviously it looks like that 4-hour time frame is quite overextended. Look how bullish it went. So in that case, you may tell yourself, well, maybe we can trade longs down here from the discount side up to the premium side, but I'm going to focus my attention mostly on shorts in premium because the idea is that, hey, wait a minute, this is probably where the market's going to retrace quite a bit to make that 4-hour higher low. So I don't really want to trade more than scalp trades in discount. I'm looking to build a short position in the premium section of this range for an extended move down until I see something like this occur, where I've got that shift in structure that's occurring, or a range that's showing me that retail traders are getting stopped out on the low, meaning that smart money is more than likely what? Building long positions. So that's the basics of what a range is. It's really not complicated. Really, really not complicated. Now, there are ways to make it complicated, and unfortunately, that's what we're going to be covering in this series. But in terms of the basics, this is the basics of a range. There really isn't a whole lot to it. So we know what? We know that we pull in an uptrend, we pull the high before the low, just like we would with the path tool. You have to pull a high before a low to mark a swing high before your swing low. Therefore, your range tool, which is, again, it's a Fibonacci tool. These are the settings for the Fibonacci, the 0, the 1, the 0.5. And I actually use percents, and I use my labels on the right. So we know that you pull in that direction, knowing that the equilibrium being touched is what we confirm as a range. And we know that in a downwards trend, you pull your path tool down, making the lower low before your lower high. So you pull the Fibonacci from the low upwards to the high, and the same rule applies. Once you touch that midpoint, we know that we have a potential range. We also know that Sometimes you don't get the range and price continues on its merry way down, up, down, up, down, up, or up, down, up, down, up, down, which tells us what? It's just not ready for a range yet. We also should know that there can be ranges within ranges. So meaning that even though there was no range right here, and we'll call that 1 hour structure, even though there was no range in that circled area, perhaps on a lower time frame, there could have been a range here, or a range here, or a range at that high and a range at that low. Very commonly, that would be the case. Now, it's up to you as to whether or not you want to trade every single range that comes by your way, because I'm telling you, it'll be very hard to do that because there's so many ranges. Even on one asset, you're within a range, within a range, within a range on a regular basis, whether you know it or not. In fact, even Bitcoin on the weekly chart was in a range for an extended period of time until it finally broke down from that range. And if we remove all these drawings here, you can see that, oh, look at this. Price was in somewhat of an uptrend, and then it had an aggressive move up where we had a high, we had a low, and you had the 50% being touched right here. Monday, July 26th of 2021. And then this was the indication that, oh, wait a minute now. We have smart money engineering longs from retail traders to enter shorts. I wonder why they're doing that. I wonder why the range isn't just breaking up. Well, because they wanted to bring the market down. So knowing that, knowing how to draw a range can tell you a lot of things. First of all, we know that deviating one side of a range usually means you're going to the other side. It also indicates where smart money involvement is. And from that, we can also determine, hey, we know this is an area that you want to short mostly, and this is an area that you'd look to long most.